Welcome back to the Argyle CFO Leadership Forum. My name is Brittany Sullivan with Argyle, and it's great to have everyone joining us today. A couple of notes before I turn things over to our esteemed speaker. First, a quick reminder to stop by our sponsors' virtual booths at any time during today's event and for the following week. Our partners are committed to providing you with valuable content and a great overall experience. At any time during today's event, you can visit their virtual booths from the main agenda page, which includes complimentary materials, information, and meet and greet opportunities. To ask questions throughout the session, simply type into the Q&A chat and we will address your questions at the end of this session. Now, without further delay, I would like to introduce our speaker, Simone Grimes, Chief Financial Officer at Acadia Insurance. We're excited to have Simone with us for a keynote titled The Sustainable CFO. Welcome, Simone, and over to you.
Thank you so much. So you heard a little bit about me. I'm very interested in learning about who's in the audience. So there are some questions that are going out in a poll, and so I'll be really excited to see your responses. I will tell you a little bit more about myself. As Brittany mentioned, I am the CFO of Acadia Insurance. That is part of the W.R. Berkley Companies, which is a publicly traded company. I wanted to specify that I'll explicitly not be discussing anything specific to W.R. Berkley, nor representing its views, ESG strategies, or goals. About a little bit more about me, I studied sustainable investing at Columbia University, as well as ESG governance for the boards of directors with NACD, National Association of Corporate Directors. And additionally, I've worked with 3 public companies and their boards to develop ESG frameworks, identify and measure ESG metrics to include scope 1 and 2 emissions, and to report out on Form 10K, as well as via an annual sustainability report. So we have some objectives today, and about 30 minutes to cover them. So what I wanted to do is really touch on reviewing our current ESG frameworks, why we report, how how companies are implementing ESG practices. We'll use some examples. So BP, as well as Munich Re, which is an insurance reinsurance carrier that's trades in Europe. Opportunities such as credits, technologies, financial instruments to reduce companies' footprint, as well as, and I'll give some examples vis-a-vis carbon offsets and green bonds. So first and foremost, why do companies measure and report on ESG? We have to ask the question, if ESG is so great, and if there's so much value, intrinsic value received, why aren't all companies doing it? And that can be answered quite easily. It is a cost-benefit analysis. So similar to when Sarbanes-Oxley was implemented, the implementation of a new reporting requirement is expensive. It's expensive to correlate the data, measure, quantify, regularly report out on it, as well as take actions to mitigate current strategies. So there's a cost component. And then when we get to the benefit component, aside from assets that are specifically green investment assets, climate risk really hasn't been adequately priced into the stock and bond markets because it's challenging to show any correlation between carbon emissions and stock returns. So for many companies, absent a requirement to do so, they're continuously weighing the cost versus the benefit and making determinations along the way, whether they want to be fully aggressive and make a lot of forward-looking commitments versus waiting until more requirements come down. So, when we think about ESG and where companies are vis-a-vis the current standards, we have to consider, why is that being done? So here we're really showing, why do companies report? So generally speaking, it's because they want to, or someone's making them. So thinking about, who are those companies that want to and why? So companies that want to, generally, it's tied to their mission, their ethos, their values. It is a competitive advantage, and it's profitable. When we think about carbon markets and other foreign revenue streams that can be associated with green assets, and then, of course, risk management. So avoiding any future losses, including reputational risk. And then someone's making us. So regulatory requirements, investor demands, shareholder expectations, and again, risk management. I'm going to take a bit of a pause just to kind of see who we have in the audience. Okay, so it looks like about 1/3 are represented by US public filers. So that's great. I think as we go through this, a lot of this will be familiar to you. And then we have 10% international, and the vast majority, 60%, are not listed and currently are not reporting. We have about 14% that are mandatory reporters, 14% that are voluntary, and the large majority, 71%, are not reporting. So that's great. It's nice to know who's in the audience. In terms of companies that have been rated by the ESG rating agencies, it looks like only about 23% in the audience have gone through that process. So we are going to visit a rating for a company through MSCI. And so for those of you who've been through that process, I'm sure you're familiar. For those of you who have not, you know, there is a website out there and you can plug in your company name and find out whether they have been rated and what are some of the comments. And then in terms of the industries represented, it looks like the vast majority are not manufacturing or banking, insurance, reinsurance. I mentioned kind of the energy industry, manufacturing, and banking, because those are the industries that currently have the most requirements at present. So, you know, if you're in one of those industries, I'm sure you've been through some version or iteration of aggregating and collecting data, whether you're publishing it through a public sustainability report or to, you know, investors or various stakeholders. You know, those three industries likely have had some good exposure to ESG and reporting. Yeah. So getting back to kind of, you know, the reason that, you know, as of today's date, a company might be reporting, you know, I said it's basically they want to, so there's something in it for them, or, you know, we have to, someone's making us. So when we think about companies that want to, you know, here's some examples of companies that are either receiving a stronger value proposition or are profiting from their ESG and climate commitments. So Unilever and Patagonia, they have incorporated sustainability into their brands as a differentiator. So it's part of their value proposition. Unilever, I'm sure most of you know, but I'll just say it, is a multinational consumer goods company that's integrated sustainability into its core business strategy. They've heavily invested in sustainable brands such as Dove, Ben & Jerry's, and that has resonated with their consumers who prioritize ethical and sustainable products. So it has been profitable for them to do so. Patagonia, you know, that also is a well-known brand. It's an outdoor clothing gear company, and it really has built its brand around environmental and social responsibility. So before there was ESG, there was CSR, corporate social responsibility, and they really did build their brand around that. They're known for their commitment to minimizing their impact on the environment. They also promote fair labor practices, and they donate a portion of their profits to environmental and social causes. This has really positioned them as a strong ESG company, and it attracts customers who value that. So again, it's part of their value proposition and it's value accretive for them. Tesla, you know, Tesla, everyone knows the brand. You know, they have been generating revenue from the sale of carbon credits for at least 8 consecutive quarters. So these credits are known as carbon offsets, are allowances and a way for companies to offset their emissions so they can be bought, sold, traded. It is a revenue stream and it is profitable for them. South Pole Natural Capital Partners, these are companies who their business is climate solutions. So they are leading providers of climate solutions, including carbon offset projects, sustainability consulting, and services. So it's part of their core business. So it gets back to they want to, because there is a value proposition to them in doing so. The Business Roundtable is an organization, it's nonprofit, but it represents about 200 CEOs of major US companies. And in 2019, they really challenged the shareholder primacy theory. So many of us who studied economics, we know that Milton Friedman is known as kind of the author, or at least put pen to paper and published the theory of shareholder primacy, which really stated that the sole purpose of an organization is to maximize profits for its shareholders. That really forms the decision pattern that a company would make. This has been a theory that American companies have operated on as early as 1932. So it wasn't new when it was penned, but it did codify that as a concept. And it's been one that, you know, American companies and many students in finance, economics, et cetera, know, have studied, and have understood. Well, in 2019, the Business Roundtable, so again, these 200 CEOs got together and said, you know what? We're going to challenge that theory. And now we are changing it to say that we are no longer just for the benefit of shareholders, but we're for the benefit of all stakeholders. And all stakeholders is defined now as not only the shareholders, but customers, employees, the environment, the communities in which we sit, et cetera. So expanded who we are serving as an organization, and made a decision that one of the objectives, a key objective of a company, is to better society. And at a minimum, that a company cannot operate if society doesn't exist. And so there's this kind of agreement that that is the purpose of a corporation. However, I think it's fair to say that while 200 CEOs signed this pledge, we are not seeing 200 companies actively and aggressively pursuing ESG metrics. So there is still a bit of that cost benefit disconnect that does go back to the shareholder primacy, because while this new notion has come into play, we still measure companies based on, if they're a public filer, based on their share price and their ability to return value to their investors. So there's still a balancing act that's happening. And, honestly, I would say that's appropriate. One of the challenges here, of course, is trying to change the concept from short-term goals to long-term. And, for shareholders, honestly, it is a quarter by quarter or daily decision whether to remain invested in a company. And so there is that kind of natural tension that will continue to exist for the foreseeable future. Now getting to, someone is making us report. So here we kind of think about the regulatory frameworks that exist. This is a map showing kind of what countries and relevant regulatory regimes, as well as stock exchanges, where they kind of are in the continuum of requirements. We note that, the most stringent to date is the Euronext stock exchange, quickly followed by UK London Stock Exchange. So when I do an example, I am going to show you a company that is, when I referenced Munich RE, we're going to talk about a European company, which, just represents a bit of more of the continuum in terms of maturity in requirements, level of granularity in terms of disclosures, maturity of the program, et cetera. In terms of the US, because the majority of the audience, we're sitting in the US, we're representing US companies, where we stand to date is, so far the SEC has issued interpretive guidance on climate change. They've also, in 2021, announced that there would be a renewed focus on climate-related risks as part of the SEC examination priorities. And, in that same year, 2021, we saw some penalties. Bank of New York was an example, as well as other, warning shots. I would say that the actual dollar value of the penalties were not hugely material to the companies. However, it was a warning shot to make sure that all companies knew that the SEC was serious about this. In 2022, we saw proposed rules combating greenwashing, which is, defined as misleading or deceptive claims by US companies and funds on their environmental, social, corporate governance qualifications. So this is really an admonishment to companies to get much more granular, not make claims that are broad and generic and that you can't actually stand behind, and to really double down on a need to get much more scientific, which we'll see in some of the European filers, in terms of how you're quantifying, measuring, and reporting. And then, in 2022, we also saw a proposed issuer rule to require companies to provide certain climate-related financial data and greenhouse gas emissions insights in their public disclosure filings. Staying on the concept of who's making us, it's not only the regulatory environment. There are stakeholders that have heavy influence on most companies, whether they're public or not, in terms of demands and guidance that they are making on behalf of a broader base of stakeholders and shareholders. So BlackRock, State Street, Vanguard, leading investment companies that have the authority and the scale and materiality to dictate how the companies that they're invested in, which is many companies, including many publicly listed companies, requiring them to make more disclosures, et cetera. And then ISS and Glass Lewis are the largest proxy advisory services firms. And so what they are doing is annually issuing kind of a guidance for the year of what are the areas that they will focus on when they make their recommendations during proxy season. And so what is happening and what we've continued to see over the past few years is ISS or Glass Lewis may make recommendations against either a particular director for a public company, against the slate of directors, but really is holding that top level of the company accountable to making a solid commitment on ESG. So some examples would be ISS, which is the largest and most influential proxy advisory service, adopted a say on climate, which really encouraged and mandated that organizations provide complete and a rigorous plan for ESG, and that they make a commitment to be net zero by 2050. That's in harmony with the Paris Climate Accord agreement, and to actually do a rigorous actual GHG greenhouse gas emission performance metric. Additionally, they stated that they would recommend against or withhold votes for the chair of a company's nominating and governance committee if the board has no apparent plan to be more diverse, ethnically, racially, et cetera, and that beginning in 2023, they would also add a gender component requirement that by 2023, a firm needed to either state what its plans were or exemplify that they have considered all of these diversification requirements. And then with regards to G, governance, ESG, they would withhold votes for the board chair for companies who have significant GHG emissions and are not taking the minimum steps required to mitigate those climate risks. So we start to see that in addition to when we look at the who's making us column, it's much heavier than the we want to kind of side of the equation. And there are a lot of factors at play that are forcing the issue even in advance of SEC and other regulatory requirements. These are some examples of actions that have been taken over the past few years. So I did mention Bank of New York. They were charged fines in 2021 for greenwashing. So again, that's overstating their impact on climate or making other misleading statements in their reports. ExxonMobil, this is an example of the power of not only the forces I just mentioned, but also activist investors. So in 2021, ExxonMobil was challenged by Engine number 9, which is an activist firm, and they were able to reclaim 3 board seats. So we are going to talk about BNP. And so when we do that, just remember the ExxonMobil story. And then Volkswagen, I believe we all remember the huge hit to reputational risk that they took with the emission scandal, where they were falsifying emission results in their vehicles. I'm just going to take a second and go to the chat. So there's a question that says, of voluntary reporters, do the majority feel the time benefit weighs higher or the latter? You know, when we talk about, again, those voluntary reporters, generally speaking, there is a value proposition that they are getting back. So again, it's either profitable for them, it's value accretive, or it's part of their differentiation strategy or their value proposition. So they are choosing to be more aggressive on the ESG spectrum because there is a direct and quantifiable value that they are receiving back. So I would say that it's absolutely it. You know, the notion that a business is in business to generate profits is always going to be the case, and that would be why they are being more aggressive in that regard. Okay, so how companies are implementing ESG. So, you know, so the main way that you will see a company's commitment to ESG is going to be through its sustainability report. So sustainability reports have become very common for publicly listed companies, but privately held companies are publicizing them as well. You can often go onto a company's website that's not publicly traded, and there will be a link to its sustainability commitments, its report, you know, a message from the CEO, chairman, et cetera, that kind of states what their commitment is. So when we look at that, those statements, those reports, you know, any written or publicly stated declaration of their commitment to sustainability, some of the questions that we're really looking to answer and what we're looking for in those disclosures is going to be, has the organization, number one, have they committed to a carbon reduction pledge, such as net zero? Does the organization have a committed timeline to transition out of carbon? So the majority of companies are making that commitment by the year 2050. Is climate change management a check the box exercise, or is it deeply entrenched within management, within strategy, and is it represented at every level of the organization, starting from the board, getting to the executive suite, and all the way down the organization? Are you seeing that commitment, as well as through the supplier, their supplier value chain? What are the organization's emissions trends? Have they met their prior targets? So, you know, are they saying that I'm going to make this commitment within 5 years, and then in 5 years they're saying, well, we didn't make it, here's our new set of commitments, which is essentially moving that milestone down the road? Or are they consistently meeting or exceeding those targets? And how reliant is the organization on what we're going to consider and call some, and what is determined as questionable greenwashing methods, such as sole reliance on carbon offsets. And I'm going to talk a little bit about why that's important and why we really don't want to see that being the kind of cornerstone of an organization's ESG commitment. In the chat, please let me know if any of your companies are using another acronym for ESG. So like in the tech space, many companies will say ESGC, so ESG plus cyber. And then in Europe and other countries, we are seeing companies refer to ESGH, so that's adding health into the equation. So if that is you, and if you're familiar with that type of additional acronym, or have another acronym that I haven't mentioned, you know, you can drop that in the chat. Okay, so when we think about how to successfully implement ESG, there are some, you know, standard steps. So we'll kind of go through those a bit. So number one, your organization, and especially if you have not yet engaged in this process, you know, number one, it's about chartering your ESG framework. So establishing the people and the resources that are going to support that, clearly defining roles and responsibility, a cadence for meetings, and what are those deliverables going to be. You want to codify your ESG efforts, so establish that framework, align your mission, purpose, strategies, and governance around that, and identify some short and long-term opportunities for goal setting and measurement. You also want to tell the story. So when we go to sustainability reports or other statements, It really is about the story of the company, how ESG, sustainability, a commitment to society or diversity, how that is a part of the company's story today and what it will be in the future. How that actually correlates to the business's core strategy, its core operations, and then essentially ensuring that there's buy-in throughout the organization. And as I mentioned before, within the supply chain, because that gets to scope 2 emissions. You want to set annual goals and articulate how you will measure success. What has become much clearer is the need to define the measurement methods. So when we're talking about GHG emissions, there are several standards for how to measure it. And generally speaking, a company should explain how it's measuring it so that the commitments it's making make sense. And then kind of looking in arrears, you can see how they're measuring it and what progress they've made compared to other organizations who may be using a slightly different measurement method. And there are several organizations out there, independent organizations, that will validate the measurement method. And just as a CPA firm would offer an opinion, they will offer an opinion about the measurement method. And then lastly, report out, as I've mentioned, that's generally speaking through a sustainability report. What you see here is kind of the cover of BNP's sustainable report. Oh, shoot. Okay. Quickly, these are the main ESG frameworks. TCFD, that's the most widely adopted, at least in the US. SASB, also very specific to the US, and GRI is currently more adopted by European companies. These are the rating agencies, so agencies that come in and offer an opinion, and we're seeing here kind of what are the standards that they use. BNP. So in 2020, BNP issued its proclamation that its goal was to get to net zero by the year 2050. And when I mentioned what we're looking for in terms of commitment like this, we're looking for whether it is fully integrated into the organization and whether it's credible. But BNP represents an organization where, generally speaking, their commitments have been deemed to be credible. They align with the Paris Accord, and they do not overly rely on commitments such as just purchasing and selling carbon offsets. This really shares a little bit about why we don't want to see carbon offsets. Generally speaking, they're hard to track. So a carbon offset will be like a company that's saying for every amount of emissions that you put out, we'll plant a tree. So it's hard to measure. It's hard to do a correlation. It's not really transparent, and it doesn't generally represent a strong commitment. So for BNP, they are focused more on divestiture, which is kind of what we want to see. How have they done so far? So since their initial commitment, they have made significant progress, and we see that through their carbon price. So they have an internal carbon price of about $100, which is on the high side, and that's helpful because it really shows that they have a commitment towards change. Here's an example of how BNP is rated. So they're rated A, which is average, but when we compare it to other oil and gas companies, generally speaking, this is on the more favorable side. I did mention ExxonMobil, who would have been on the laggard side. Again, this is engine number one that was able to challenge Exxon. Okay. I do want to show you Munich Re. This is a more advanced company. You can also go to their actual sustainability report and look at it. But what I really like here is the very clear correlation between their core business, which is insurance. So insuring companies, organizations against losses. They're using the term CAT, which means a catastrophic loss. That's either weather related, through a problem in society. COVID would be considered a catastrophic loss. What are those sensitivity areas that they're very focused on? And what investments are they doing that directly correlate to their business, that they're able to execute an action in their day-to-day investments? So this is an example of a much more advanced company and really showing you kind of how it can be done and how it should be done. Munich Re has also made significant advancements in kind of making taking the green assets, and making it part of its core business. So Munich Re has issued green bonds, and what green bonds are is a security. It follows a typical bond schedule. It has recourse, it has a coupon rate, etc. But the proceeds are guaranteed to be used for green projects. And then on a regular basis, they're reporting out on what those projects are, details around what those projects are contributing, and how much dollars of that initial bond have been allocated. Very detailed, very easy to follow, and it has been successful. They're on their third issuance. Reminder of what are the climate risks that we're usually thinking of: transition risks, regulatory risks, and physical risks. And I believe we're running out of time, so I do want to visit the questions and make sure that if we have additional questions that I'm answering it. And in the meantime, I'm going to put my contact information here so you can absolutely stay in touch. What is causing so much controversy over ESG? Good question. And, that really is, it goes back to what's the value, being forced to do it, and the cost. So, we know everyone does not agree on these concepts, that this is a natural good, it has to be done for society, and who should do it. So there is controversy around it and a lot of pushback around firm regulatory requirements. And is it common to buy ESG funds? Yes, companies are buying ESG funds, such as the green bonds that Munich Re issued, as well as others, in order to round out their ESG strategy. And I want to thank you all for your participation today. It was a pleasure to speak with you. I hope you got something out of it. And if you have additional questions that you don't think I answered today, please feel free to connect with me on LinkedIn and send me a question. I always answer. And with that, I'll turn it over to Brittany.
Thank you so much, Simone, for such an excellent keynote. Any questions that we did not get to, I'll be sure to share with you. So thank you so much for addressing those. I also want to thank everyone who joined us for this session. This session, along with all of today's content, will be made available on demand following the event. Thank you again, Simone.
Thank you.